Here's a riddle. It's April 2026. There's an active war in the Middle East. The world's most critical oil choke point is still closed. The ceasefire that was supposed to end it all? It's visibly falling apart on live television as people are watching. And yet, the stock market is at all-time highs. The S&P is up, the Nasdaq is up, investors are popping champagne, and every major financial network is telling you the same thing. This is a relief rally. Markets are celebrating world peace. Except there is no world peace. So here's the real question, the one nobody in traditional financial media is asking. If the war is still happening, why did stocks just have their best week in over a year? The answer has nothing to do with peace, and everything to do with how Wall Street actually works. Let's get into it. To understand what happened, we need to rewind to February 28th. The US and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. And Iran responded by doing something that hadn't happened since the Iran-Iraq War in the 1980s. They shut down the Strait of Hormuz. Now, if you're not a shipping nerd, here's why that matters immediately. The Strait of Hormuz is a 21-mile wide channel between Iran and Oman. And through that tiny gap flows roughly 20% of the world's entire oil supply, about 17 million barrels every single day. When it closes, the global energy market doesn't just slow down, it starts to break. Markets responded exactly as you'd expect. The S&P 500 fell nearly 9% over 5 weeks, its worst losing streak in almost 4 years. Goldman Sachs confirmed what their prime brokerage desk was seeing. Hedge fund selling was the most aggressive in 13 years. One commodity analyst went on camera and said that recession was, quote, too light a term, that depression was more accurate, and that $250 to $300 oil was almost guaranteed. Sentiment was clear. Everyone on Wall Street was terrified, and they positioned accordingly, meaning they bet heavily that prices would fall further. Remember that, because that setup is the entire story. Then, on April 7th at 5:32 p.m. Eastern, Trump posted on Truth Social, "Ceasefire with Iran." And when markets opened the next morning, it looked like someone plugged the economy back in. The S&P closed up 2.5%. The Nasdaq gained almost 3%. Over 400 stocks in the S&P finished green. And oil cratered. Brent crude fell 13.5%. WTI dropped over 16%. The biggest single-day oil decline since April 2020. Every major outlet called it a relief rally, markets celebrating peace. Here's the problem. Maritime intelligence firm Windward, which uses AI to cross-reference GPS signals with satellite imagery to track actual ship movements, reported that by midday on April 8th, only 5 outbound tankers had been detected moving through the Strait of Hormuz. 5. Out of a pre-war baseline of about 130 daily transits, a 96% decline. The strait was still functionally closed. The war was not over, but markets ripped anyway. So what actually happened? A short squeeze. And here's how it works. When a hedge fund shorts a stock, they borrow shares and sell them. Their betting prices fall so they can buy them back cheaper later, return the shares, and keep the spread. It's a bet that things get worse. But if prices go up instead, they're stuck. They still owe those borrowed shares, and now they cost more. Their broker sends what's called a margin call. Close the position immediately or add more capital. No debate, no strategy meeting, just forced buying. Now here's the key data point. Goldman Sachs tracked that heading into the ceasefire. Short exposure to broad market ETFs, SPY and QQQ, was at its highest level since the pandemic.
The market was about as short as it had been in 5 years. When prices started rising on April 8th, those margin calls cascaded. Funds had to buy. That buying pushed prices higher.
Higher prices triggered more margin calls. More margin calls triggered more buying. That's domino number one, and it was just the start. Domino number two, CTAs. CTA stands for Commodity Trading Advisor, but the name is basically irrelevant today. These are systematic, algorithm-driven funds that trade everything: stocks, bonds, currencies, futures, and they do it entirely without human judgment. Their models watch price trends and respond automatically. Trend down? Short. Trend reverses up? Go long. They don't read news. They don't care about the Strait of Hormuz. They follow price. Goldman estimated that CTAs were sitting on roughly $30 billion in net short positions heading into the ceasefire. But the moment the S&P crossed certain trigger levels, thresholds hard-coded into their models, those funds didn't flip to neutral. They went maximum long. Goldman initially estimated these funds would need to buy back around $40 billion to exit their positions. The actual number was $86 billion across 5 trading sessions. Goldman's own records flagged that as a top 5 buying speed print of all time. Not this year, all time. And none of it had anything to do with Middle East peace. The algorithms were responding to price movements, not geopolitics. This same playbook has run before. December 2018. The Fed had been hiking rates. Stocks had been crashing for months, and hedge funds were extremely short. Then, Jerome Powell stepped on stage and said one word: patient, signaling a slowdown in rate hikes. The Dow gained over 1,000 points in one session. First time in history it had ever done that. Was the economy suddenly fixed? No. The positioning was so extreme that one word triggered a mechanical cascade. August 2024. The Bank of Japan hiked rates for the first time in 17 years. The yen carry trade unwound. The Nikkei dropped 12% in a single day, then bounced 10% the very next day. Different catalyst, identical mechanics. Once you understand this pattern, you see it everywhere, and you stop being confused by it. Domino number 3 is the options market, and this one is the most important of all. When you buy a call option, a bet that a stock goes up, there's a dealer on the other side who sold it to you. That dealer has to hedge their position in real time to stay what's called delta neutral. To do that, they buy the actual underlying stock. When prices rise, they need to buy more stock to maintain the hedge. It's automatic, it's mechanical, and it amplifies every move in the direction the market is already heading. A financial data firm called Spot Gamma flagged something called a negative gamma regime heading into the ceasefire. Plain English, the options market was configured so that any upward price move would be automatically amplified by dealer buying. Price goes up, dealers buy, price goes up more. Now here's the number that should stop you cold. Same-day expiration options. Options that expire at the end of the day they're purchased now account for around 63% of all S&P options trading. On peak days, over $2 trillion in notional value changes hands in a single session. Every one of those options forces a dealer to hedge in real time. On April 8th, the options market was essentially a giant amplifier pointed at the stock market, dialed to maximum. Short squeeze, CTA flip, dealer hedging. 3 dominoes falling in sequence. But here's the bigger picture. This isn't a bug in the system. It is the system. 20 years ago, markets were dominated by humans. Portfolio managers reading earnings reports, analysts modeling cash flows, people trying to figure out what companies were actually worth. That market is largely gone. Today, 63% of all U.S. stock fund assets are in passive index funds, more than $13 trillion flowing on autopilot.
Because those funds are market cap weighted, the bigger a company gets, the more they automatically buy. That's how the Magnificent Seven now make up over 33% of the entire S&P 500. What's left of active investing has consolidated into a handful of giant, leveraged multi-strategy funds: Citadel, Millennium, Point72, running at 4 to 8 times leverage with strict automated drawdown rules. When they hit their limits, they don't debate. They sell, immediately, all at once. The dominant players in 2026 aren't analyzing fundamentals, they're reacting to price. And when they react, they stack on top of each other. So what does this mean in practice? Every time something dramatic happens, a war, a ceasefire, a Federal Reserve announcement, a presidential tweet, financial media will have a story ready. Markets surge on peace hopes. Investors cheer Fed patience. Stocks rally as uncertainty fades. Some of it correlates.
Most of it is the narrative people construct to rationalize something that already happened for entirely mechanical reasons. Reasons that were set in motion weeks before the headline ever appeared. Here's the practical implication. Stop trying to trade around news events. Quant funds with hundreds of engineers have already priced in the reaction to the reaction to the reaction before you finish reading the post. The retail investors who tried to trade the ceasefire announcement the same way they did the 2021 meme stocks, they got run over by the same machine. But, and this is important, understanding this actually gives you an edge. The best buying opportunities of the last decade all looked like catastrophes when they were happening. March 2020, Q4 2018, August 2024. Every single one was a mechanical unwind where positioning got too extreme, everything collapsed, and then the squeeze went the other direction. The fundamentals didn't change in a week. The positioning did. The market we were all taught about in school. Rational, efficient, driven by the underlying value of businesses. That market is a ghost. What replaced it is a feedback loop of algorithms, passive funds, and options dealers amplifying each other in real time. The headlines are just the story people tell afterward. Now you know what's underneath them. If this is the kind of analysis you actually want, the mechanics, not the narrative, hit subscribe. Because the gap between what financial media tells you and what's really happening has never been wider. And we're just getting started.